Okay. So I'm not sure if I should just start, or if there's anything to be said in advance, or say? Okay. Okay. Buenos dias, and es buongiorno. Good morning. And once again, it's a pleasure, and it continues to be a pleasure to be here with you. I started with a topic yesterday. I mean, you will notice that they're connected, but you won't see the full connection, I think, until tomorrow. Okay, because I'll try to. It's like we'll close the circuit of money in a sense, by tomorrow. And so this has to do with the issue of monetary policy. I mean, what is the nature of it? And obviously is something that we ought to be doing or not. Okay. And again, I'm going to be doing a little bit of a brief historical digression. Okay. Because what happened in terms of the mainstream, we saw really an important revolution in the way in which central bank policy is framed. Okay? There was an important ideological shift that took place over the last half century, more or less. Okay? And this started, of course, with the collapse of the Bretton Woods system that some would have associated, perhaps, okay, although it wasn't so cut and dry. Some of you don't know a bit of the history of Bretton Woods, would realize that Bretton Woods was a pretty clumsy system in many ways. But it was nonetheless sometimes still referred to as something that was connected with Keynesian ideas, Keynesian views. Now, I would argue that Keynes actually, I don't think he was such a strong supporter of fixed exchange rates, as an example, although he was more in favor of capital controls and all that. So it depends here what we mean, okay, by Keynesian. But nonetheless, and until the early 70s, we had a certain framework in the way in which they also framed policy, monetary policy, as we'll see, in terms of mandates, what they were committed to, and so on and so forth. Okay, and then of course, when we got the oil price shock, okay, in the middle to the late 1970s, okay, there was, what happened was a coup, basically. I would argue it's a coup, because of course the inflation rate had nothing to do with what would be quantity theory notions of how somehow inflation occurred. Okay? It was purely, I mean, if anybody who would have seen that visibly would have said, what has this got to do with the central banks creating inflation? Well, the answer, of course, is that they did not. Okay, but somehow, because of these oil price shocks and how they filtered themselves through the system in most of the Western countries, it was there that there was a monetarist coup, a real coup, in the sense that they took over and they made these policymakers at the time believe that it had to do somewhat with the quantity of money, in a sense, which, as I said, if you believe it's an endogenous variable, then yes, there was a sense in which the higher prices were pushing up also the money supply growth, because of course businesses are seeing higher wages that they have to finance, as an example, and other costs. They would have to necessarily borrow more, and that creates a greater M. Yes, there is, but it was not, but the causality, needless to say, was completely in reverse, okay? But they made everybody believe at the time, big times, actually, it happened. In our case, in Canada, for instance, they went monetarist in 1975. But also it coincides with when they established wage and price controls. Okay. what are called incomes policies. And in Canada, between 1975 and 1978, we had incomes control. So, and they also introduced monetarism of controlling the money supply, as we'll see, this whole notion of how they control the money supply. And in a sense, so if you see any slowdown a bit, you're wondering what, people would be confused whether it was the Bank of Canada that was doing it, or it was simply because they were controlling wages and also other incomes, okay, and prices in certain sectors that also led to that kind of control. So in a sense, it's important to take note that therefore there was a revival of the quantity theory of money, or what became called monetarism, okay? But they resuscitated it at the time when there was no necessary reason other than the mere fact that there was a lot of inflation going on, okay? But there was no necessary causality. It's not as if the Bank of Canada all of a sudden start pumping money, helicopter kind of story, okay? None of this. So how could you conclude that? Well, they made that, I would argue, they literally believed in something. Maybe they were honest about it, but you could be honest in religion, in the sense you believe something, whether or not it exists, okay? And that is the problem here, okay? They see a certain phenomenon, and we think is that it's something from above that explains it or not. Now, I will not waste any time on Milton Friedman's, helicopter money and all that, because it's, it's really, as I said, it's complete nonsense that nobody believes in, even in the mainstream, for sure, nothing. But the worst basic precepts, I call them, of monetarism here, okay? Two that I would like to just mention what they are, okay? First one was really, remember when we talked about a bit about the history of money and theories about money and all that? Well, this is a direct lineal descendant of the mainstream view of money that we talked about. And it's a kind of pseudo, I call it, commodity view of money. Okay? Pseudo, of course, because needless to say, nobody was using gold anymore as a backing for the, as they did in the 19th century. But, it was now simply a pretension of what would be similar to the kind of logic that was being espoused, at the time of the currency school and all these others. As I say, if you go back historically, all the way to the Middle Ages, literally, as we said, okay? And so that was the first thing. It's similar, but it's a kind of, what do you call it, surrogate. It's a way in which they pretended that base money now is the same thing almost as if it's gold, okay? But without being so, needless to say. But it's that kind of pretense. And it's important to see how this feeds into the whole logic here. And also, of course, central bankers in most of these Western countries that went monetarist, both in Canada, we went monetarist in 75, then with Volcker and later on, all of them in Britain, all of these major industrial countries at the time, all were going in that direction. And they adopted what I would argue is a supply side view of how you control monetary aggregates, which I will argue here turned out to be a colossal failure. Now, following that original coup, theoretical monetarist coup, okay, central banks began at the time to adopt monetarist jargon, monetarist vocabulary within that Friedman quantity theory of money logic, okay? Because they didn't do that before, okay? And I lived through it literally, I could tell you, as a student. I was there in the 70s. Now in Canada, for instance, it began in 1975, this kind of supply side view of what the Bank of Canada at the time called monetary gradualism. It was the idea that somehow they're going to slow down the growth of the money supply, okay? And of course, they were, as I argue, it was somewhat of an illusion that they were adopting monetarism, because they never said that they were controlling base money. Remember, even in the little diagram I had yesterday where, you control the base. In the old days, it was the idea of gold reserves. Now, instead, it's just the base money, which is money that is currency, and reserves in the, that are, in the banking sector. These would somehow, were believed to causally determine the increase in the money supply. And which money supply? Because then there's a question, you have the whole dilemma. For instance, Milton Friedman used to argue, after doing all these regressions, basically, with Anna Schwartz in the 1960s, he had concluded that the way in which we control the money supply, yes, you control it through the base money, but it's to impact the growth in the money supply now. For him, it was M2 money supply. In Canada, it was M1. Okay, they used instead. Why? Because they probably did all these stupid regressions to figure out which one was more correlated. And it turned out that M1 was more correlated than M2, okay, at the time. Okay? There was no other reason for it. They just invented that one, okay? And they were trying to control and target M1. So remember, the whole logic of monetarism is to target monetary aggregates. As I said, Milton Friedman, it would have been M2. In our case, it was M1. In the US, instead, under the kind of Paul Volcker, it actually was, in a sense, even more doctrinaire than in Canada, because in Canada, they never talked about the base money. It didn't exist. I mean, you will read up in the reports, you couldn't even find data that they produced on that, which is bizarre, when you think they're adopting monetarism. But in the case of the US, they were a little more doctrinaire than Canada. They tried to control base money, okay? But it was by controlling unborrowed reserves, through the usual, it's like open market operation or whatever. And the effect of this was basically to lead to a skyrocketing of interest rates, of short-term interest rates, okay? Starting with the federal funds rate. Yeah. And which really brought a collapse. By 1981, 82, we had a big recession. In fact, it was the biggest before we got the global financial crisis and then the COVID. Okay, but that was a big one then. Now, following again this recession of 81, 82, that ended completely. It was the coup de grace, as I write there, of monetarism. They never spoke about it again. In 1982, the Bank of Canada, in fact, there's a famous quote, I didn't put it here, but there's a famous quote from the governor of the Bank of Canada. And he said, it's not our fault. It is not us who abandoned M1 targeting. It is M1 that abandoned us. Okay, meaning that they couldn't control the damn thing, and they had to, they were pretending to, okay, but in fact, they actually were, trying to follow it, but it didn't work out, obviously, as I could say. And after some refocusing, because then they were drifting, the policy drifted, okay, during the 1980s. And eventually, in the early 1990s, starting with New Zealand, which is a bit ironic, because if you know, I've written this in some places, but the irony is that New Zealand, all it was trying to do initially was trying to control public sector wages. Now, what has that got to do with inflation targeting, through interest rates? Okay. Well, it started that way. So in a sense, even when they started, it's very important because we're going to see now the whole nature of monetary policy. Even when they the first country there where the Federal Reserve in New Zealand, in this case, when they first invented it, and we followed like 6 months later or something, just after them, okay, in Canada, February 1991 in our case, and it was I can't remember the month now in the case, but in 1990, okay? So we followed each other very close. And we began doing inflation targeting, okay? But ironically, even the original one in New Zealand The reason why they finally very clumsily kind of ended up to where we got with inflation targeting started because the government wanted to control. There was a currency crisis that preceded it. They had a very difficult problems. And one of the things they wanted to do was to control wages in the public sector. But somehow they said, this is not a nice way, especially if you're on the labor government or something. It doesn't look good. So what they actually did was to adopt something else that is akin, as we're going to see, to an incomes policy. Okay, but it was trying to control wages originally, literally. Okay, and if you could read up on that, it's amazing how it was so close. So in this case, they no longer paid lip service to controlling inflation via monetary aggregates. So the quantity theory was dead in that sense. They had to figure out something else. And indeed, as it turned out, they started, they actually recognized that money is endogenous, okay? Because at the end, the way in which they tried to control the inflation rate, of course, is through the interest rates, okay? The administered, the central bank controlled interest rates, okay? Now, the policy officially narrowed the actual mandate of central banks to that exclusively of trying to, in this case, target an inflation rate. And it was quite consistent with what they had already been doing since the breakdown of the Bretton Woods system after the early 1970s, but they never said it that way. Because in our case, I'll give you an example. In Canada, even during the time of monetarism, they never said they were, as we mentioned, they never said they were control-based money. What they were doing was raising interest rates that they controlled, the central bank controlled. They raised interest rates in order to slow down the growth of demand for credit and therefore the demand for money. And somehow that led to lower supply, quote unquote, or slowdown in the supply. And that was the way in which they actually were doing it. So they always, in a sense, were implicitly recognizing that money supply was endogenous, so to speak, M1 or whichever they liked. But as I said, it was through the chimera, I call it, of the quantity theory of money. Somehow, although it's in reverse almost, they still pretended that they were adopting monetarism. Okay, which, as I said, it made no sense to anybody. I was a graduate student in 1975 still, and I remember I couldn't make sense of this thing, what they're doing when you try to actually figure it out, because they used the vocabulary, but they weren't actually doing that. Okay. Now, hence, as in the kind of Vixelian type world, okay, these inflation targeting central banks now took the view that the money supply was essentially endogenous, okay? And that inflation ought to be controlled now by changes in the central bank, rates, discount rate, or in our case, it's the overnight rate, which is the interbank rate. When at the end of the day, they have they have to meet their obligations in terms of through, as you know, in the clearing. When they have checks clearing or whatever, some banks may end up being in a deficit position at the end of the day. Some will be in a surplus position of reserves. And in Canada, as you know, well, we'll see how there's zero reserve requirements. So it's not, you don't have to meet any reserve requirements, and they're going to be trading among themselves at the end of the day at the overnight rate, which is what the Bank of Canada targets and sets, basically. Okay. Now and it is basically it's set at the midpoint of 50 basis points, what we call corridor system, okay, of interest rate control here. Now, the logic of inflation, I'll go through that in detail in a minute. I'll show you some diagrams to show you what I mean, how they do this, okay? Now, the logic here behind inflation control was done through, as I said, the interest rate lever here, the instrument. And a reduction of inflation could be achieved, of course, by raising interest rates above what they then start calling the natural rate of interest. Now, that was a term that was alien, completely alien to the profession before the 1990s, okay? But somehow they linked it up, even though it's not absolutely not obvious, okay, with the natural rate of unemployment idea, or the NAIRU. Now, you ask yourself, okay, remember that NAIRU was something that, or the natural rate of unemployment, was a vocabulary, was a term in a theoretical construct, okay, that you find in Friedman's, Phillips curve analysis and all that, right? The vertical Phillips curve and all this sort of stuff. Well, but they start to talk about the natural rate of interest as being the counterpart to the natural rate of unemployment. Even though if you're going to try to figure out the theory, it's not obvious at all to link them up that easily. Because one is a labor market concept, and one has to do with this fictitious notion of a loanable funds kind of, theoretical loanable funds theory of the financial capital markets. Okay, and what is it? How does that correspond with the labor market concept? There's a jump. Let's call it that. In a sense, conceptually, there's a jump, but somehow the notion of natural became more acceptable, and which is exactly Wicksel's vocabulary, going back a century earlier. Okay, and in Canada, for instance, this switched towards this kind of Wickselian framework, okay, of we set interest rates in order to achieve some inflation target when we have the money rate set by the central bank being equal or close to, at least, the natural rate of interest. Even though what exactly this natural rate, they're still having a hard time trying to estimate it now, okay? Because it's one of these fictitious concepts, really. It's nebulous. In fact, we're going to see that Wicksell himself said you shouldn't even bother with it, except that implicitly we could figure out where we are about that. I'll explain that later. Okay, but I'm just saying that even Wicksell said it was a waste of time trying to estimate a so-called natural rate of interest. Okay, he said that even though he invented the theory about it. Okay, which tells you something. But so in Canada, we have a two-step formulation as it emerged with inflation targeting. In 1991, as I said, just after New Zealand, we adopted inflation targeting in February of 1991. And initially, it was not even an actual numerical value. It was a target range. It was a range. And eventually, by 1996, it became a single digit at the midpoint of that target range, which was at 2%. Obviously, so the spread is 50, as I said, if you think of it in terms of what they were saying, and so it would be like 1 to 3%, let's say, for the target range, and 2% is the inflation target. Okay? Now, I mean, it's fine. As long as it gives you enough space to be able to not make a mistake, because you want it wide enough to say that we're still targeting. Okay, but it cannot be too ridiculous. The spread, otherwise, it becomes a total joke. Okay, now so what we have here, that at the same time, the bank completely abandoned the control of bank reserves. Totally. We adopted in 1994 zero reserve requirements. Okay. And as I said, zero basically, yeah, for most banks, because it's easy to borrow at the central bank or through the interbank market. So you don't need to hold reserves, okay? Except for some cash if banks, if the public wants some cash from the banks, type of thing, But that's almost zero nowadays because we use mostly electronic means, to pay. And in the US, it was much more complicated story, though. We started very early designing this framework that I'm going to explain a little bit better, because it's important to see how they did this inflation targeting. And in the US, instead, they were much slower with the adoption of, for instance, the 2% inflation target idea, okay, only in 2012. I mean, us, it was in 1991. So you can see there's a long lag there, so to speak, and the adoption also of a hybrid kind of corridor system, which is very important, because if you're going to be doing through interest rates, you need this thing. And I'll explain to you exactly how it is in one sec. But it is, in fact, the US was much later in the way in which they followed the same at the end, more or less, okay? But it took much longer. Now, here's the standard corridor system. This is from an old paper I did in the over, was it 14 years ago or something? I can't remember exactly now. It was discussing what happened during the global financial crisis. But this is the system that it was there. So for instance, what we call the corridor system, and it's very important, because if you don't have these lower and upper bands, okay, for the interest rates, okay, then, I mean, if you start, let's say something happens, as we're going to see, because let's say they're spending by the state or something, it will lead to an overabundance of reserves, which will then push it to zero, okay, if you don't have a floor. So for instance, let's take, so the overnight rate, if I could get this thing to work, okay, the overnight rate here on the vertical axis, for instance, this is what we had in 2008, 2009. They brought interest rates down to the lowest level then possible within that existing corridor system then, okay? And the corridor system is this, it was a spread of basis points, a 50 spread, between what they could borrow directly at the Bank of Canada. You could directly borrow, but it's at a penalty rate, so to speak, okay? Of, let's say in this case, it was 0.75, less than 1% at the time, okay? But the target was 0.5. So it's 25 basis points below. That's the target. And they always hit the target. I mean, there's rare, unless they were falling asleep or something, they always hit the target, by the way, okay? And it's easy, I could explain why, but the point here is that, and the lower band now, the other lower is what it's the rate that they paid to banks when they held positive balances in the interbank market. Remember, as I was saying, every day there's going to be transactions going on, and there's clearance. If you're paying by check, as an example, right, it clears, at the bank. But at that point, okay, you're going to find some banks in the red and some banks in a surplus situation. Those that are in surplus situation and cannot lend, cannot find a lender, they are going to get that lower interest rate on it, paid by the central bank to the bank for deposits that are held there, okay? These reserves held at the central bank. Well, the ones who, for whatever reason, normally they would never have that problem, because the banks they know exactly, they could just phone each other or whatever, text each other to say, look, we're in the red by so many millions, we're borrowing at the overnight rate, and that's it. So it always cleared to zero, as I have there. But in fact, if somebody by mistake, or sometimes because it has happened, I don't think, but during the financial crisis in particular, in September 2008, the markets, after Lehman Brothers, the markets seized. They stopped. So banks were no longer lending to each other, even in the overnight market, okay, the interbank market, because they didn't trust each other anymore. Remember this trust? They didn't trust other banks if they were borrowing because they were in trouble for cash liquidity, Or is it because they just, that day they were in the red by some, but it's normal kind of thing. One day in the red, sometimes in the black. Okay. But in this case, they're not, and it had to be through and there, of course, they were borrowing at the discount window, at the bank rate, the top rate we're borrowing at, the ones who did not. So that's why you may have some of them stuck with reserves, because they can lend it at the higher rate, the target rate, and stuck at 25 basis points below, because the other banks were borrowing at the Bank of Canada directly. And so you get this kind of bizarre situation. And so this is the important thing now. So but you could see how they control the interest rate, because all they have to do is raise the floor and the ceiling, and everything just moves with it. They control it very easily, okay, those interest rates. It's not a complex. I mean, a monkey could be doing that almost if you train them. But honestly, it's very easy. And that's the corridor system. Now, as much as they had abandoned monetarism during the global financial crisis in the US primarily, and then in both US and Canada, primarily during COVID later, okay, that central banks began also to adopt quantitative easing. Now, we have mentioned that a little bit yesterday, which I argue here, it's a kind of return to a hybrid type of monetarism. Yeah. Why? Well, actually, just from the title, I said the conventional monetarist unconventional crisis policy. Okay, so they presented this as unconventional. Think for a moment. And what was the idea? It was to build up reserves in the banking sector in the hope that this would provoke lead to bank lending, which is the exact monetarist logic. Okay, but they presented it as the non-conventional thing, as something revolutionary almost, and packaged that as what they call quantitative easing. And as most of you know a little bit about that, quantitative, QE asset purchase programs that they instituted, for instance, in the US, was simply a policy, therefore, of I say, inundating the bank sector with reserves, okay? With all sorts of, they purchase assets, government securities or even private sector securities. And that led all of a sudden to all this liquidity that was created in the system. Buildup of all these reserves in the banking sector, in the private, commercial banking sector. And of course, now that led, so think of it, because of everybody now is in a positive settlement balance situation. Remember, each day they're clearing. And it's like, but normally, unless you do something like with QE, they would clear, but it would be at zero bound because they don't have to hold reserves. Okay, so it will be zero, because otherwise it's like a tax. If you're not getting anything on it or very low, okay, why would you do that? I mean, you're not fool. So the point here is that in normal times it would be zero. Let's say in Canada, for instance, zero reserve requirements, and there would be each day it goes one way or the other. That's all. Some banks, half of them are in the red, half are in the black. Okay, basically, yeah. If you think of now, because of this QE policy, it just led to an abundance for everybody. So every bank now is going to find themselves in the black. Okay. Now, when that happens, what do? You don't want to hold reserves for nothing. Okay. So what do? You are trying to somehow lend it out. But this is a hot potato that you're holding, because all it does is changes hands. I mean, if you're actually first of all, you won't find others, because if everybody literally is in the black here, I mean, they're all holding the reserves, then you could dream on there in a sense, but you will not be able to lend it to anybody. Okay. And beyond this, is in an endogenous money world, the demand is determined by other things. It's, in the crisis, demand actually lending was going down totally. In fact, I'm sorry I didn't bring this, but I had an article in 2017 in Journal of Economics where I was studying carefully what was going on there. And if you look at the data, let's say in the US, lending was plunging while reserves were going through the roof there, in a sense. We're all rising of the bank. So that doesn't sound like monetarism. It's the opposite almost. It has nothing to do with it. Okay, what's going on? Reserve. So all these banks are stuck with these reserves, and essentially it pushes down the overnight rate to its minimum. Like, for instance, here is the example for Canada. Now, as you can see here, the bank rate was, let's say, at still there, but as you see, the target overnight rate, in a sense, fell to the minimum point. The overnight rate, actually, not the target, because they were no longer. So the overnight rate went down to 0.25. In fact, it stayed like that for a while. A very low, almost zero. Let's say the overnight rate of the Bank of Canada, and it collapsed because everybody had these reserves. So let's say I put here. Remember, this is now zero. If you look at the graph here, this is the zero line for the total amount of, whether it's a surplus or negative situation. Now everybody's in a surplus situation, let's say. I forget the number there, but it was that for Canada, by the way, literally. They just put in about 3 billion, so nothing. But you don't need much to be able to let the thing collapse to in the US, it was collapsing almost to zero. And because at the time, they still didn't have the corridor system. And the only reason why it didn't collapse exactly to zero, if you look at the data, is because they have a two-tier kind of system there. Because they also, what's the term? They deal with these other types of institutions that are not banking institutions as such. Okay, so they also have that where they provide that kind of access to credit, and they. So it never literally, but almost, it was literally almost zero, much below Canada at that time, the overnight rate, or the federal funds rate that they call it in the US. Okay, so what we could see here is that this direct effect did not exist. The monetary stuff did not play any role. But one could say that the only minor, let's call it stimulating effect, is because it brought down interest rates to the lowest level within the corridor system. But it didn't matter very much because, as I said, if you're in a crisis, firms are not looking for, for that interest rate there, whether it's high or low when they want to invest, because you're not going to invest, period, if you're in a crisis. Okay, so it really doesn't matter. But all that is not the direct, the way in which it was sold. Okay? If you read all that literature, you will see that it's basically monetarism dressed up, okay, as this unconventional policy. Okay? But it never was. Now, okay. This brings us to the whole nature of how central banks behave in terms of their mandates. Okay? And here, I would like to briefly just mention how we evolved again, and how, in fact, we do things now. Okay. Historically, at the time when all these central banks, in the 19th century, for instance, were obsessed with commodities, money, gold, okay? Central banks, all of them linked their policy directly, to gold here, to the price of gold, okay? And in this case, they would issue currency on the basis of the gold reserves that they held or claimed on, okay? Now, during the Great Depression and the early post-war era, for a short period, obviously, and I say exceptionally during that period, okay? The central banks actually adopted what I would call a multi-goal mandate. Okay, I mean, I don't know about the Banco de Mexico, but if you look at in our case, our bank was created actually during the Great Depression, was founded in 1934. And it was at the time, and if you read their mandate, the preamble to how they created the structure of the bank, you will see that they were mandating the central bank to address not only inflation, they all paid lip service to that, even though it was a deflation during that, during most of that period. Okay, the concern would have been deflation, not inflation, but they had that there, and they had to address the issue of trying to somehow control the price level, as they called it, but also production, employment, real variables. Okay? And even dealing with balance of payments problems. Those were all integrated in the mandates. Okay? And so it was not a single inflation target or something. It was wider. There was, multi-goal, as I was saying. Okay? And as we saw, of course, after the 1970s, until the global financial crisis, literally, their main focus, their single focus changed and was subverted, if you think of the multi-goal mandates, back to one thing which was just, because under the gold standard, what they had to deal with is the price of gold, basically. Make sure they were fixed. Otherwise, they'd have to adjust by raising interest rates, and attracting capital flows usually. Now, in this case, no. And so it became that the official, policy after the 1970s, whether it was the monetarist type or whether it became inflation targeting in the 90s, starting in the 90s, that was the only thing that was discussed by central banks. Now, during and after the global financial crisis, this changed a little bit. Okay? And they began doing what they called flexible inflation targeting. In fact, in the literature, you start seeing that even before the global financial crisis, there are discussions about it. But it's only afterwards that what they do is talk about now. I mean, you're trying to figure this out. There's strict inflation targeting, which is that all you have to worry about is the inflation rate, get it to 2%. Flexible inflation targeting now was a nuance. It was a kind of adjustment to that by allowing for the central banks to also look at the situation on which was previously mandated. It was already in their official mandate. It was subverted during the inflation targeting because they played this game where they would have to get the government, like in Canada, just to give you an example, it's actually this year again, now they have to renew the mandate of the Bank of Canada. And it's always this thing about 2%, okay? It's been that since almost 1991. As I said, then it was a ban, but by 1996, it's been like that. So for 30 years, essentially, we have been 2% inflation target. Hasn't changed. As I said, it's a monkey. You could just, you could have it and they press it, that's it, But the point here is that after the financial crisis, they started to kind of change a little bit, okay? And I think it's very important now to understand what happened. I'm going to show you, because they started adopting, now we're going to get to that in much detail. They were adopting what is often referred to as a Taylor rule, okay? The Taylor rule, now I'll go through it in much detail, but just to say that the Taylor rule is the idea that they're looking at two variables, the output gap and the inflation gap vis-a-vis their target. But the output gap, the way we normally interpret it, the way Taylor interpreted, it's not because they're worried about unemployment or output in the sense of trying to get it to, let's say the potential output or full employment or whatever you want. No, nothing to do with that. That's the Yellen rule that I'll get to later. Okay. The Taylor rule simply says that you should be looking at both because you have to worry about the inflation rate, not just the current, this year, let's say, inflation, whether it's too high relative to the target, if it's at above 2%, in which case you should raise interest rates, the overnight rate or whatever, but also look at the output gap, because the output gap is going to tell you, if you believe in the Phillips curve, which I don't, by the way, but if you believe in the Phillips curve, okay, then it will, in fact, tell you what the future inflation rate will be. Okay, so you have to look at both. You want to try to stabilize the inflation rate to the target level. So if you look at both, you say, oh, inflation is above, it's now 3% or whatever, 4%. So you got to raise the interest rate. But you also have to look at if there's an output gap problem. Not because the output gap is a worry for you, but it's only a worry because next year might predict even higher inflation. In which case, you have to raise interest rates even more if it's too tight on the output side. The output gap is too tight. So that's why it's purely concerned the single focus, even though you see output gap as if somehow they're saying it's like a dual mandate kind of thing. They also have to achieve full employment, like, in the mandate of the US Fed is that, as we know, some of you might know. But as I said, the Taylor rule framework is merely, are they acting on that? And the reason why this is a sort of important thing is because we estimated, we did a simple exercise in terms of pool regression, but in the paper that I referred to there, 2019, okay? But if you look at this is just one graph. And if you see here, I'm sorry that I can't catch, okay, here's now if you look at the continuous blue line there, okay, that's the real overnight rate. So inflation adjusted overnight rate. And the broken line is the inflation rate. Now, if you look carefully, there was in 1993, 4, whatever, it was even below. It was about 0, below the band. The band was between 1% and 3%. And in Canada, in this case. Okay, but you can find it in other countries, the same thing. Okay, and we did the estimate for, 14 countries that do inflation targeting. I'll show you. Well, we'll see it here. This is the estimates, and I'll get to it in a minute. Okay, but if you look at this, so this is the band, 1% to 3%. The inflation rate, the only time when it was out of the band, if you look carefully, and in each case it was below, not above, below. Okay, the band, below the lower band, and it is in 1994, there around then. And after we had another serious recession, by the way. And then again, guess what? It was in 2009 there, okay, where the inflation rate was below the band. It was, almost at 0 in Canada. But look at the interest rate, what was going on. Now, the inflation rate was very stable within that 2% for most of that period. Yet, look at what they did. They started already, even before the global financial crisis, we see those interest rates collapsing. But most importantly is in 2008, they're the big one, the kind of mother of problems of the recessions. Look at how that completely plunged again. As I said, we hit a 0.25 nominally, but given the inflation rate, it was way below that. It was minus 2%, okay, in real terms. And that's the important thing. Now, it stayed that way, okay? They didn't bring it back up. Now, if you believe in the kind of Vixelian or whatever, inflation, strict inflation targeting world, you ought to have brought it back up, back to normal. But there was no normality. And they spend a lot of research money trying to show that the natural rate all of a sudden had fallen dramatically. To say why those interest rates now, they stayed so low. Now we're trying to figure out what the heck happened in Canada. I mean, was there, I don't know what, maybe it could have been an asteroid, you know, that could have destroyed all the industry there. I mean, there's got to be something to explain this. But no, they fixed it up there. They should know it's because the natural rate, remember the natural rate is something a bit fictitious here, that even Vixel said you shouldn't worry about. But they did that. And there was a mini industry within the departments of these central banks across the world. I'm sure even here in Mexico, trying to estimate these natural rates, or what they call the neutral rate of interest. It's another term, okay? Yet, so as I said, they had to justify it somehow, not because they were in such a crisis that they feared a collapse of these economies. They had to maintain it so low at the time, because that was their only instrument they had. Rather, it's because there's this kind of almost heavenly thing happened, you know, during the crisis that brought the natural rate so low, and therefore we must try to adapt. And that's why we did that. So you could see how the story is told in order to justify this change. And you could see it here. We did this for 14 countries, okay, that did inflation targeting. And this was for the period 1990 to 2018. The article came out in 2019. We just did an exercise where we estimated the coefficients here of remember the Taylor rule, which has these two variables there, the inflation gap and the output gap. So we used that to estimate, and then we throw in a dummy variable in that, you know, just to see how it would work. And you can see that the only thing that is really most significant, other than the constant term itself, is the dummy variable. And it fell by 3.6%, okay, after 2008, meaning it just shifted, as we saw with the graph there, it just shifted down. And this is not just for Canada, this is for 14 countries that we're doing this, okay? So they started to implement what they call now flexible inflation targeting. But again, why don't they call it a dual mandate or something else? Okay. Why are they fearful of that? Okay. No, it had to be fitting the logic of the theory, even if they tried to make reality fit the theory somehow by inventing these neutral rates that they measured, and which meant nothing. Now, this brings us to the Taylor rule. In fact, versus the Yellen rule that I would like to say something about, because it was a debate, if you go back the last decade, when she was the head at the Federal Reserve. Now, as I was saying to you, trying to interpret the Taylor rule could be quite a challenge, because it could mean, if you look at it, quite naively, we think, well, that means that they're doing the dual mandate, meaning that they're concerned about the output gap, or if you could put their unemployment gap, whatever you want, okay? You could be looking at that and on the inflation. So that's compatible with the notion of a central bank that is engaged in pursuing a dual mandate. However, okay, in reality, it's not. As I was telling you, okay, it could be interpreted as a single goal mandate, which is what it was. And by that, I mean that they were looking at the output gap as a kind of, I mentioned this as a forward-looking, you know, indicator of inflation. So if the output gap is too tight, according to if you believe in, there's a Phillips curve thing, then you must also raise interest rates, not just higher because the inflation now is, let's say, higher than the actual target, but also you compound it now more, okay? So we're going to see that it leads to a kind of overcompensation in a sense, but I'll explain what that means. It's a term now that I don't think I want to yet say more about, but you will see the problem, okay, because of what it does. But it's a forward-looking notion that we must try to think of it, iron over time, what should be the inflation rate, okay? And as you know, this is the usual, what we call the Taylor rule here, where I is the nominal central bank, interest rate, benchmark, or like the overnight rate. Rho is a constant term, which I'll say something about because all the estimates of these constant terms are treated as if rho is the so-called natural rate. That's what Taylor says. It's the natural rate of interest, okay? And alpha and betas are just policy coefficients, okay, where they weight. For instance, in the Taylor rule, the original Taylor rule, going back to the 1990s when he wrote about it, he had weights of 0.5 for each. So alpha and beta were each 0.5, okay? So you weight equally both current inflation gap and the expected future inflation gap, if you want to call it that, looking at it through the output gap, okay? And actually, I just realized I put Q here. It's supposed to have been, I don't know what the heck I did wrong, but it's supposed to have been Y here, Y star, I don't know. Anyways, same. Okay, anyway, but also you could use this, we could redo that using the unemployment rates, where beta now is where the current unemployment vis-a-vis the so-called natural unemployment rate, or the NAIRU, okay? But it's the same argument. Now, the Taylor rule postulates a single goal mandate of 2% inflation, okay? And where the weights emphasize present versus the future inflation, how the bank conceives of it, how forward-looking is it or not, okay? So if you put a lot of weight into that, let's say into the forward-looking, it looks as if you're worried about future inflation, or the other way around, okay? It could be anything. But there has been a whole debate about these weights, okay? And this brings us to the Yellen rule. Yellen rule, now Janet Yellen, as some of you know, she was more Keynesian type, a little more Keynesian type. Very mainstream, absolutely. But a little more, let's say, vis-a-vis whoever there, like who was before Ben Bernanke, she was clearly more Keynesian than him. Let's call it that, okay? But both mainstream. Needless to say, you have to be head of a central bank. It's almost like a precondition. And but she interpreted the original Taylor equation, and there was a whole fuss around that, a whole debate around that, okay? If you go back when she was there in the early 2010s, okay? As to how this would be interpreted within the dual mandate. Now, all of you might know, heard of what is the dual mandate of the Fed. It goes back to a law passed, enacted in 1978. And they're different, sometimes it has different names, but it has to do with, it's the Price Stability and Full Employment Act, or something akin to that. I stand corrected the exact but it has full employment in there and price stability. So they have to try to meet both in a sense. Now, people believe in the Phillips curve and all that. Well, you cannot exactly meet, but you have to somehow play around with that, okay, to be able to achieve the optimal, so to speak, okay? And needless to say, while Ben Bernanke pretended, or Taylor pretend that they have a dual mandate, but they don't believe in it. They would like to get rid of it tomorrow morning, especially Taylor. And they might, depending on this new governor, and obviously with Trump, who very much, along those lines, as we'll see, okay? with John Taylor, because he's also a Republican, you know, all the nonsense around that. And I'm just saying this is the, so, but Janet Yellen was, as I said, much closer to the notion of a dual mandate in the sense of trying to achieve high employment and at the same time trying to, you know, get a low inflation rate. And therefore, for her, the way she interpreted the Taylor rule, she said, I'm fine with your Taylor rule story, but I interpret it differently. And she argued that first, we have to be concerned about the output gap, not because of its inflation potential for the future in terms of determining it, but also because we should be concerned about it. You know, that it's not a good thing to have mass unemployment or something. Okay? And so one was that. And the second thing is that she tilted, as you could see, the weights towards the output gap. So as just to show you the difference, the Taylor rule is 0.5, 0.5, but the Yellen rule, let's say, I mean, in one paper or presentation, whatever she did, she had those, the ones that I have there as weights. Okay, she says, yeah, we should worry about inflation, but we should also worry about the gap. And I put more weight on the gap. So in a sense, you could see that this Taylor rule thing, even though it's really the way Taylor framed it, he wanted it to be about the single mandate of fighting inflation, which, as I said, goes back to the 1970s view of central banks, how they should fight inflation and nothing else. Why? Because if you believe in the natural rate of unemployment and all that, it's because, of course, if you get output too high, you will then generate inflation. So we must forget about output. We have to worry about just getting that inflation right. Okay, you will avoid the temptation of generating inflation just to reduce unemployment. You know, the usual Friedman story, you know, the accelerationist hypothesis, you know, of the natural rate of unemployment and all, of the Phillips curve, you know, the vertical Phillips curve stories. So here, Janet Yellen is saying, no, actually, she didn't believe in the natural, or in the, you know, the Friedman accelerationist story of the Phillips curve. She did believe in the Phillips curve, but in a kind of short run sense only, okay, as a stable short run sense, okay. And now, if we were to take such a simple Taylor rule reaction function, okay, of the central bank, this was a way, in a sense, to render, therefore, the IT regimes more flexible. Remember, it was totally compatible with that. So remember that graph I had earlier. Now you could justify it by using the Taylor rule and saying that if you're more concerned about unemployment, then, you know, we could maintain interest rates very low. And by the way, throughout, before the global, well, not the COVID crisis, during that whole decade, after the global financial, interest rates were very low. In fact, were negative a lot of the time. Okay? And you know that it has something to, it's not about inflation, except for this justification about the neutral rate, the natural rate fell because of heaven changed somehow things. Okay? But otherwise, you know, that was the justification of it. But the real justification, I think, is simply because they were fearing that if we don't do that, we may collapse into some other form of crisis, okay, throughout that period. Now, I have argued, and we'll discuss that later, though, that central banks should actually have a multi-goal mandate, you know, that favors employment stabilization, or if you should be committed to full employment, absolutely, okay? And also they should be concerned about the long-term distribution of income. I will try to discuss this, which is the way, by the way, Keynes, if you read some of his works, was concerned about, okay? In the setting of interest rates, you know, where the central banks do not simply become the, what I call the executive arm or the executive committee of the rentier class, the ones who benefit from the high interest rates, let's say, but rather follow some other rules that would not do that, that would support more, let's say, labor income in terms of income distribution. And some of these, like one is the Pazinetti rule, that we'll talk about this a minute now. But there are different rules, okay? So we don't need these stupid Taylor rules as a way to look at things. But it's just the way in which it is. Now, this brings us to these new Keynesian, or what sometimes became called by the late 20th century, early 21st century, as the new consensus in macroeconomics. Okay? Because if you think of how a central banker, even today, thinks of the world that he's looking at, he's going to be looking at it in terms of this new consensus macro model of the economy. And it rests on essentially three equations. It's a very simple world. Okay, of three equations almost. You don't need any Walrasian, general equilibrium, or whatever, anything complex. Okay, and it's based on the principles. There are certain key principles of this macroeconomics. Okay, that fits beautifully with, and that includes a Taylor rule in there in terms of response function or reaction function. First is that monetary policy dominance. Okay, that is to say, the central bank's primary role is to maintain price stability, low inflation, 2%, whatever. Okay, and it's done through interest rate adjustments. That's the first rule. Other things should not be of concern. And it's monetary policy that could do that. Fiscal policy, they downgraded because it creates all these problems. Fiscal policy is, first of all, it's considered ineffective if you believe in the Ricardian equivalence or some of these other theories, okay? And of course, okay, believe in the long run that, at least, if not in the short run, now it depends who, they believe in balanced budgets, as the neutral kind of fiscal policy view. Now, it's based on three relations, the way in which they frame their whole macroeconomics. What are these three relations? Well, first, there's what they call the IS curve, or the demand side aspect of the economy. It's represented in one simple relation, okay, which is that aggregate spending or aggregate demand is a function of the real interest rate. Remember, it's the inflation-adjusted real interest rates, okay, R, I have there, a symbol. And so it's YT is a function of all these other autonomous spending out there. It could be government spending and, whatever, animal spirits there for investment even. But, and also they're a function of their interest rate, the real interest rates. Okay? There's interest-sensitive component of spending. Now, so that's the first equation. I say it's just a very simple thing, the interest, but it's real interest rates, very important that, because we're going to see VIXEL didn't quite do it the same way when it comes to these inflation things. Second is the inflation adjusted, of course, the expectations augmented, Phillips curve story, which is the supply side. Remember, there's a demand side, and then there's a supply side here. This is the supply view of pricing that arises because, of course, the rate of inflation is a function both of expected inflation and the output gap, okay? As I have there's equation at the bottom here, because I stipulated them. And also the third one. So these are the two, demand, supply, okay? And the third thing is that you need, if the central bank has to act now, behave neutral, it has to follow the Taylor rule to achieve that natural rate. And the natural rate is that rho, that, as you could see in my equation here at the bottom, okay, is what they, so if everything else is zero, if there's no output gap, there's no inflation gap, then real interest rates would equal rho, which is the natural rate of interest. Now, again, I've written a great deal about that stuff. And you could pick them out of a hat almost. There's so much stuff on that, how they estimate the natural rate. But the original one is the one here you get from the Taylor rule, which is a bit of a nonsensical one because it tells you, okay, that the natural rate is some constant all the time. It's some averaging process. When you, let's say if you do an estimate like we did there with the regressions, right? You get that what do you call it, the constant term that appears at the end when you set zero for the two variables there, the output gap and the inflation gap, okay? That the inflation rate should be the natural rate should be equal to some number, let's say the 2%. It could be, they have different, and depending on the estimates, yeah. But in reality, if you ever read Wicksell, which I have, going back to his original stuff in 1898, he actually believed that it was a very unstable function. And that in fact, central banks were always chasing that natural rate, because if they didn't, it would lead to an explosive price level, either one way or the other. Unstable kind of inflation one way or the other, or deflation. So but they somehow pinned it down this way because it's very easy to see within the Taylor rules. You can see it's just a residual thing at the end. And you say, well, that's the natural rate that they should be estimating. Okay? And therefore following, okay, and achieving for central banks. So to fine-tune the economy by keeping the inflation rate on target, monetary policy now must rely on two important relationships to effectuate changes in that, inflation rate. Okay, and this is by changing the administered rate of the central bank, the central bank rate. And as I said, it's the relation between interest rates and overall spending, which is the aggregate demand, and the relation between aggregate demand and the level of inflation through or unemployment there, okay, of the Phillips curve. Those two relations must hold for monetary policy to be effective. But, you would think if you believe in this framework, then they must exist in order to be able to pursue it. Otherwise, you're pursuing a fantasy, okay, if they don't exist. Okay? And monetary policy cannot do, however, as we'll see now, if they don't exist, they cannot do what it claims it's doing. I mean, if they're saying we're targeting inflation rate at 2%, but those two relations don't exist, okay, empirically, observably, then how could you possibly conclude anything else than that, in fact, their whole policy framework is wrong and ineffective in the first place? And that's what brings us now to this paper that I mentioned as one of the readings, okay, on the reading list there. And that's the only one that is in Spanish, by the way, because it was presented to the Central Bank of Argentina in 2021. And we quote a well-known study done by heterodox economists on this first equation, the IS curve, okay? Because it rests on the strong interest sensitivity of spending, either investment or consumption, to have it working. And let me quote what they say here. They say the transmission mechanism of monetary policy to aggregate spending in new consensus models relies on the interest sensitivity of consumption. It is difficult, however, to find empirical evidence that holds that households do indeed raise or lower consumption by a significant amount when interest rates change. Okay, some authors have generalized the link to include business investments, but a robust interest elasticity of investment has also been difficult to demonstrate empirically. Now, this is just one study. And in fact, this goes back to the 1930s. I mean, it's so ironic that we have these, because even Keynes, actually, there was a student here who, there's chapter 11 of the general theory, which has investment as being a function of remember, the gap between the marginal efficiency of capital and the rate of interest. But then the next chapter, and you would think that Keynes was a little bit, I don't know, contradictory, bipolar or something, because he in chapter 12, he says basically that it's determined by long-term expectations, by other or animal spirits. Interest rates do not play much of a role there at all. I mean, there could be some sensitivity. And indeed, what we find is historically, as much of the evidence, and even recent stuff, and we've seen, I'm just quoting these guys here, but there are many studies that I could give to you, which show, first, investors, they want to build a plant, let's say General Motors plant in Canada. Well, they're going to listen more to Trump than to look at the interest rates. Okay? Nowadays, I'm saying there are other factors that play a role, okay, that determine when you engage in actual physical investment, not in financial investment here, or placement, as we call it in French. Okay? We clearly know that investment is not very sensitive. There's some sensitivity, but very, very little, if at all. Okay? Where there is some sensitivity, you know where it is? We find that primarily in the housing market, okay? With households purchasing, so there is some, but that's not the whole thing, and that's household investment, let's call it, okay? There's some sensitivity there. So, and consumption as well, okay? The only way in which it does is indirectly a bit, because if you are, as I was showing yesterday, household indebtedness, so if you're on the bottom end of the income scales, okay, not on the top end because they save, they don't know what to do with their money almost, okay, but if you're on the bottom end, okay, or in the lower half or whatever, clearly there will be some sensitivity because you end up. And it's through the credit worthiness criteria that we apply. So if a bank is going to lend you money, okay, this is where it also comes through the housing market stuff, is because they're going to look at your indebtedness to begin with. They look at your income flows, but then they say, well, yes, but how much debt do you have also? Okay. So they look at the assets, but also the liability. They look at the net amount. Oh, fine. Okay. So I'm just saying here that this is, of course, clearly where you may find some sensitivity there, okay? Otherwise, no. And their conclusion is that the interest elasticity of these expenditures is weak, okay? With the possible exceptions, I said, some housing expenditures, consumer durable, but it comes through the problem of credit worthiness, a credit rationing issue, okay? Which is a different issue. And interest rates do feed into that, but indirectly, okay? Now, this is not because interest rates do not do damage to the economy, let's say if they raise them. It is where they do impact, we will argue, is through another mechanism that I worked on a great deal over my whole career on, that we described, now normally is being described as the income distribution mechanism or transmission mechanism of monetary policy. That is to say, the way in which central banks control interest rates, what they actually do is they redistribute income. So if you redistribute incomes, let's say to the high savers, as example, high income earners, rentiers, okay, then of course you will have an impact on the spending in the economy because you're giving more income to people who won't spend it much, okay? If it goes into the wage income, in a sense, it's the opposite. So if you squeeze rentier income, you reduce it so that it's actually leading to an increase in the share of labor income, then the effect, of course, is to boost spending, consumption spending especially. That is so obvious that, as I said, unless you live in a cocoon, in another planet almost, it is difficult to understand why economists do not see that. And I've been writing about this since the 1980s, literally, okay? And so it's not a new idea, but yeah, so that's the first relationship. Now, I know I've been told we had 5 minutes. Now is what, is maybe 3 minutes or 2? I don't know what it is right now. Okay, let me just finish the two things and then we'll stop. Okay, and we'll take a break. So what about the second relationship in our macro model here? Remember there's the IS one, which is the interest sensitivity of spending. Okay, then there's of course the second relation, which has to do with the Phillips curve. Okay, and the relation between inflation and the output gap. Well, the conclusions here, as we say, are no better. Okay. In fact, over the last 3 decades or so, literally, the relationship, if they had any such thing, I will argue that they never actually did. And I studied this going back even when I was doing my thesis in the 1970s on the early Phillips curves. They never found that relationship. They had to cook it up, but it fit the theory. Okay? It fit the ideology almost, or the theory. So you cook it up and you do all these empirical estimates. But if I tell you even how the first Phillips curve was invented in a sense empirically, you will see that, my God, how did they do this and accept this? Okay, but I won't tell you. In fact, Richard Lipsey, who is a Canadian economist, now he's very old. He's still alive, actually. He's very old, he's in his 90s. But Richard Lipsey in 1960 was the one who popularized that short-run trade-off between inflation and unemployment. Okay. However, this same guy, in an article that I cite there in 2016, he argued, he said, we should, if there is a Phillips curve, now this is the guy who was selling it for years, okay, the idea. He said, if there is a Phillips curve, it's basically horizontal with just the ends being. And he argued, he referred to it as the non-inflationary band of unemployment rather than the Nehru, which is a point. Think of it like the vertical Phillips curve. There's only a certain point called the Nehru there, or the natural rate. He says, no, it's a big band. So let's call that, if there is one, yeah, if you get unemployment very low, it starts to push up the inflation rate, you could argue. But if you go very, very high, let's say H1 there, it starts to slow down the inflation rate. But in between, and it's a very broad range, in fact, the estimates, it doesn't change anything. So unless you create a Great Depression almost, like after high unemployment, you will not get an inflation rate down very much. Something else determines that, as we'll see. So if you accept this horizontal Phillips curve, okay, then what the heck are they doing again? Because if they're trying to control the inflation rate by raising unemployment through higher interest rates, first of all, the higher interest rates may not influence demand very much, as we said, except through the income distribution channel. And secondly, is that even if they do, it doesn't impact on the inflation rate if you actually look at the studies done on these Phillips curves. So they live in a kind of cocoon, as I said, and therefore, these are what we say are devastating conclusions or consequences, totally, okay? Now, what then do central banks really do? Well, let's discuss that after the break. Okay, I mean, I think I'll save, or do I have a? No, take your time. Oh, yeah, okay, because I don't want to, okay. So as I said, what they think they do is not what they're actually doing. It's like the captain of the Titanic thinking that he's going and there's no, whatever, there's no iceberg ahead. But in fact, this is Volcker, for instance, was the captain of the Titanic in the US at the time. Okay. And that is where, then the question is, what do central banks actually do? Is the issue. Well, as I argued, and as I personally have been arguing for since the 1980s, for sure, but it's also post-Keynesian writers historically. Now, there are different types, but the majority emphasize, recognize, ever since Keynes in 1923, in his tract on monetary reform, emphasized this income distribution aspect. So it's not new, but somehow the mainstream has managed to discard it, okay, until the global financial crisis. They start talking about income distribution effects, but they're not the same things at all, as we're going to see now, okay? And so where it is important is on the income distribution and also the wealth, effects of that, okay? Among social classes, not just individuals, agents that are all equal. As you know, they assume the single agent usually in these macro models. In the textbooks, if any of you have gone through these more modern textbooks on macroeconomics, they all assume a single agent. Euler theorem, all kinds of stuff that they pretend means that there's no classes or income classes out there. Okay? And well, I argued that, in fact, that's the critical thing. That's where the important effect of monetary policy actually is. Okay? Now, changes in the rate of interest here affect, therefore, income distribution. It's obvious. I mean, you have to be a totally autistic kind of I'm sorry for I don't want to say bad things, but I'm saying you're completely insensitive, okay, to this fact. Because obviously changes in the rate of interest directly impact, here, and how? Well, they raise the income of financial asset holders, for sure. It's direct. And because it impacts on the complete spectrum of returns, not just the overnight rate, which only impacts on these banks exchanging reserves, in the interbank market, but it leads to, think of it as like the base rate, we would say, in the post-Keynesian literature, in fact, and how they conduct monetary policy, they start at the base, which is the overnight rate, let's say, or the interbank rate, okay? And then there are markups, basically. There's marking up to all these other types of rates, both in terms of risk structure and in terms of, obviously, time structure, if you want to call it, if you look at the term structure of interest rates, okay? But they're all marked up on that base rate. And if you look at interest rates, and including, let's say, the prime rate, the lending rate, for businesses and so on, all of them very much move in tandem. Sometimes a bit off, but most of the time, when they raise, if they're going to raise by, let's say, 50 basis points, the overnight rate, you'll see that pretty much all the others are going to be compounded in the same way. Okay? So the only difference sometimes that, let's say, in the case of the yield curve, the expectations of the future bank rate will be, okay? It's not expectations of inflation. That's a nonsense story of that. Remember, much of the, if any of you have studied on the term structure of interest rates and how they're determined, the mainstream basically argues it has to do with the inflation rate. No, it hasn't to do with inflation. It only has to do with the inflation rate because of central banks. If they're doing inflation targeting, then they will, in a sense, But if they're not doing inflation targeting, then why should they worry about the inflation rate? They should worry about what will be the future central bank interest rate, they said. Okay, that's the important thing. So it's silly to think that way. And hence, financial asset holders or rentiers, from the higher quintiles, let's say, of our income scale, benefit, of course, by the higher interest rates. And as such, the policies are based, in this case, on how they will react to the inflation rate in order to protect or even to increase the real rates that are being cashed in by those on the receiving end, okay, in a sense. And if you look at central banks, what they do here, we emphasize this is, I think it's in Spanish, all that. I didn't take it out. I took the English one here. But in the article that I wrote, Louis Philippe, it's mostly it's also, the whole thing is in Spanish. And this is the effects. And I'll just sort of very quickly just mention what do these central banks do, okay? And they've set interest rates, okay, based on whatever is their mandate. And as I said, the mandate since the 1990s, like in our case, okay, has been to focus on one thing, which is the inflation rate and nothing else. But there are different channels. There's the income channel and there's the wealth channel that impact ultimately the economy in terms of transmission mechanism. Okay? Now, the direct mechanism is obvious. I mean, as I said, you raise interest rates. If you have bonds and securities, it will automatically raise them. It will give you a higher rate of return. But there's also the indirect mechanism. Okay? Because, of course, the rate of interest could influence the labor markets. If it does through this income distribution channel, not through the interest elasticity stuff so much, okay, it will be associated with higher unemployment and everything else, and that affects also the wage share of the economy. But there's also a wealth channel. And the wealth channel, of course, is, that low interest rates lead to speculative asset, kind of bubbles. Okay? And much of what we've seen, okay, over the last 30 or so, 40 or certainly years, has been that that growth has been, in a sense, associated with these asset bubbles. And this is where central banks do play a role, but it's a dangerous role to play. Because if you're trying to stimulate the economy by leading to a balloon that could burst, okay, then of course there are problems. And this is why it's important that you have proper regulations and so on, okay, in that sector. Okay? But it does impact there, okay? And now, this is the question, which is the central bank policy neutral? Okay. And I wrote a paper with a former student. We were talking about Guillermo there, Matamor, and we wrote a paper that was published in a book in 2023. And I recount a story, okay, at the beginning, because it's what happened to me. When I retired in 2018, beginning of 2018, I promised a senator, a Canadian senator at Parliament here, if you wish, okay, that when I would retire, I would see how we could change the mandate of the Bank of Canada. I promised that, literally. And I promised it the year before because they gave me a medal. I have a medal from the Senate of Canada, okay? And I was very grateful. And I said, but I'm going to do something for the community, because they would thank me for service for the community, among the things they said there, okay? And one of them was that I said, we're going to see how we could change this, okay? And the actual law, the change is now, it's in the reading still. It hasn't got to Parliament. And who knows if Carney will ever ultimately change it. But we were trying to do it, and we wrote up, and it's proposed through the Senate law, ultimately. But initially, we approached the Minister of Finance in 2019. No, yes, 2018, excuse me. Because when I retired, I wrote a declaration. I wrote up this declaration that demanded for change, that look at not only achieve full employment, forget about inflation, because I don't think they could control anything. That's my point. Okay. But so yeah, they could put in inflation if they want. It makes them happy. But the important thing is that they should have full employment, and full employment, not the natural rate of unemployment, but full employment in the Keynesian sense here. And we could establish what that is. I've done work for INET on that, literally. Okay, I'm serious. It was very clear for us. And second thing, of course, they should be concerned about income distribution as well. Okay? They should be monitoring income distribution, not just the inflation rate. 2%. Look at what's been happening to income distribution. Okay? That's what you should be worried about. And what are you doing about that? Because you do impact on it. Okay? So we did have that declaration. It was signed by a bunch of, we were about 65 economists, and we just did that quickly. And and I sent it to the Minister of Finance. And it went to the newspapers as well. Well, obviously, because we want to get them to act on that. But the Minister of Finance didn't do anything until enough pressure. And it came from the senator. Her name is Diane Bellemare. She had to retire. She reached 75, so she had to retire. But we knew each other for a long time. We were students together, literally. Okay, and so she pressured them, and we did too, obviously. But we don't count so much. And so we got the minister to meet with us at the beginning in February, literally 2019. What is it now? 7 years ago. And we asked the minister to defend what they're doing with the mandate, because we said this is not doing what it's supposed to be doing, for one thing, okay, at all. And also because we believe in the principle of full employment. And you know what the minister said to us? This is under the Trudeau government. Then, okay, minister's name was Bill Marno. And he said, this is more like a pipe dream. What is this full employment? It's very nice, but it's a pipe dream. Well, I said to him at that meeting, because we were a delegation, we were 6 of us, but to see it, including the senator, the woman senator. And we said, okay, I said, I have known enough people over the years. Said when I started studying economics, they actually said that word. It wasn't a pipe dream. And indeed, I met in the 1960s, until 1973, he was the minister. He was the governor of the Bank of Canada. His name was Louis Razminski. He was the one who negotiated at Bretton Woods in 1944 for Canada. He was a delegate there. And I said, if you read their reports, their speeches, all of them talked about full employment, but in the Keynesian sense. They never said the natural rate of unemployment. No, what is that? Yeah, and but he obviously didn't believe in it. And then we asked for the governor, but they only gave us the deputy governor, a woman by the name of Carolyn Wilkins. Very nice. No, she's no longer deputy governor, but at the time. And we, again, asked them, about the need to have income distribution as an element in their mandate. Okay? And you know what she said? That when they pursue anti-inflationary policy, it was completely neutral with respect to income distribution. Okay. Now, as I say here, in this kind of technical, okay, I'll just say 2 words here and then, because we'll get back to this. But in the kind of technical universe, okay, of these central bankers, okay, all is seen as if what they do is steeped in hard science kind of thing, They defend it. It's like the neutral rate, the natural rate. Oh, there's a real thing for them, okay? And I told her that the interest rate that is set by the bank, which is a price leader in a sense, in that industry, okay, and the financial markets, is not only a cost to borrower, but I reminded her that is also an income to lenders. If you don't know that, And it does have a real effect on unemployment, and surely effects on workers' incomes, and also on the distribution between interest income versus profit income. It's not just and workers' income. So she clearly was out to lunch, but she talked about the fact that for them, they never would consider that because. But I said, it's not you consider it. Look at the effects it has. And it's so obvious unless you're completely, as I said, autistic almost kind of thing, I'll stop here for now. Now we take a break now, okay? Okay. Okay. Just to get back to where we left off, as I was saying, at the time we met with the deputy governor, she was, defending something that to me was completely, and I think she realized it right away that it was undefendable. Why? Because I said, look, are you oblivious to the fact that when you raise interest rates, it raises income? There are two sides to the coin here. It raises costs, let's say, for people who are in debt or who are borrowing, and there's a cost. But there's also a benefit in a sense. There's a revenue that flows the other direction. And those should be of concern to you too, as a bank, a central bank. Now, this brings us to this whole issue of the non-neutrality here of monetary policy, on not non-neutrality on production, which is a ridiculous story to begin with. I mean, obviously, money is not neutral. I mean, if you take the mainstream view here, okay? But also, it's non-neutral with regards to income distribution, which is much more important of concern. And the reality is, and it's interesting because when I started writing about this, and including with Mark Lavoie, my colleague at the time, we did a lot of work on this, on the Pasinetti rule, as you're going to see in a minute. Okay, we at the time, we were speaking in the wilderness almost, like it could have been, nobody was ever talking about that. Okay? There was never. We're the only ones, me, not just Mark and I, but I'm saying, if anywhere, it was within the heterodox or post-Keynesian primarily camp that there was any discussion about how monetary policy impacts on income distribution. And I could count on one hand, if you think of anything before 2000, even among heterodox economists, I would say. But at least there was something, okay? However, within the mainstream, there was zero. And yet, if you go back over a century now to Keynes in his tract on monetary reform, published in 1923, and you see what he does. Now, he did it with, well, what he was doing at the time, he did it within a research framework that was more of a Marshallian type within the quantity theory, in a kind of Marshall-Pigou quantity theory version. He was influenced, obviously, he was a student of Marshall at the time. But if you look at what he was doing and how he was analyzing things, okay? In fact, we're going to see in a minute, it has to do with the Fisherian analysis of interest rates. But I'll get to it in a minute because that's going to give us the link with what he was doing in the track. But he was concerned about the different groups. And he had all those different groups. So he had entrepreneur income, whatever, profit income earners. He had the wage earners and he had the rentiers. And he wanted to look at the dynamics and study the impact of monetary policy on these different groups who had very different interests, very conflicting interests, in fact. Okay? And hence, this was the first time, I would argue, that any serious research was being done on that question. I knew about it, and many post-Keynesians knew about it. And indeed, if you read economists like Joan Robinson, Luigi Pasinetti, that we'll talk about because of his Pasinetti measure index that we talked about, okay, all of these were also alluding, at least saying something, when they studied monetary policy, alluded to the issue of how income distribution is affected by those policies. Okay, so it was not something new in a sense what we're doing, but it was like talking in the wilderness, because certainly the mainstream had nothing to say. They didn't give a damn. As I said, our deputy governor of the Bank of Canada in 1919 was still saying that it's neutral. Okay, And, because they believe, or even I have some nice quotes that we have in the, in fact, even in the article in Spanish that with Luis Felipe, we have a quote that I found from, what's his name there at the Mexican director of the what? Karsten, yes, I'm sorry, okay. What's his first? Agustin, yes, I'm sorry that I forgot the names. Agustin Carson, where he says exactly the same thing again, that in the long run, monetary policy is neutral, okay? And because income distribution is determined by long run factors having to do with, based on the marginal productivity theory of distribution. Now, those who don't believe in this stupid theory called the marginal, that nobody should believe, okay, really, they should take it seriously. In fact, most people don't, economists don't. Yet, if you look at what these important leaders, within the financial sector, in the banking sector, all of them were arguing until more recent times, until the global financial crisis, okay? Because things changed. They changed for two reasons. One, of course, was because we were, the shock of the crisis itself and who was being affected, but also because there were like ourselves, like there were orthodox or heterodox economists, non-mainstream economists, who were arguing about that. And that put pressure. And by the way, just to take a little footnote, after 2019, now they changed the governor in 2020 at the Bank of Canada. And guess was one of his first papers, the reports that he did, their speech, whatever it is, he talked about the inclusive society or inclusive economy. So he started talking about income distribution effect and why inflation targeting was so critically important in preventing, the erosion of lead to greater inequalities and so on. So how did that happen? If you look at any reports before that, there was never even a mention. Obviously, we did have an impact because, we shook them up, okay? And what is important here is that within the profession, we start seeing a lot of studies in the mainstream that includes now the impact it has on inequality. Okay, now the new Keynesian economics. Okay, as you all know, there's nothing Keynesian about it, by the way, and it's certainly nothing new as well. Okay, but it is a theory that is mainstream. But with the only difference being that it's not the new classical theory that believed that there was no such thing, that everything was flexible in the economy and all those kinds of things, market flexibilities. These people recognize there are what they call nominal rigidities, sticky wages and prices and all that. That's the only big difference, really. Otherwise, it's all the same stuff, okay? And that they have real effects, these sticky prices, but only in the short run. And in the long run, of course not. It's all ironed out. We're back to the classical theory in a sense, or neoclassical. Now, there are, of course, exogenous changes, let's say in the nominal rate of interest, could be non-neutral, they recognize in the short run. But even there, monetary policy cannot modify the natural levels of output, of natural interest rates, and so on in the long run. Okay, if there are effects, these effects they recognize to be only in quote unquote short run, whatever that really means. Okay, and what is the long run? Remember the statement from the tract from Keynes. He says the long run is when we're all dead. But that so. It's not really, we don't know what that means, in the long run, because we never get to it unless you die at some point, okay? Now, similarly, what you see here is that I actually have a nice quote here from Bernanke. It's a nice quote because it tells you exactly what these guys would think. Most economists, he says, would agree. Now, he's probably right about that because we're not most economists, we're just a very small minority, okay? But most economists would agree that monetary policy is neutral or nearly so in the longer term or in the long run, whatever. Meaning that it has a limited long-term effect on real outcomes like the distribution of income and wealth, right? So when the central bank says raises interest rates or lowers them, and if it persists, it won't have any effect at the end. Now, again, so to them, in the long run, things just somehow go back to some neutral world of, that is untouched by these short run, shocks or whatever you want to call them from the central bank, as they call them. Now, hence, much like our former deputy governor, neutrality holds somehow, okay, in the long run, since it cannot really affect what would be the underlying forces of like productivity and thrift, all these things that impact on income distribution as well. Okay? Now, before the global financial crisis at the time, the assumption, if you pick up any textbook, and especially more like graduate level, more advanced textbooks in macroeconomics, okay? All you have are basically, within these new Keynesian models at the time, are representative agent models. So everything starts from the representative agent, okay? And that means everybody is the same, because if he's a representative and they only talk about that guy or that woman, whoever, that agent, okay, then they're the same, okay? So everybody is the same. If everybody is the same, you cannot talk about income distribution, whether it be in the short run or the long run. Why could you? How could you? The model, the theory, doesn't open up to that. It cannot. Okay, so single agent models, obviously for them, all these households are equal if they talk about a household or if it's an individual. Okay, and therefore changes in interest rates have to be symmetrical because you said it, you've defined it that way, you framed it that way. Okay, so the inflation rate for them also, it affects it collectively because it doesn't say if you're rich or poor. If you're wealthy, which your wealth effects could be rising because of speculative, effects through the inflation. None of that could be talked about in these new Keynesian models, the original kind of stuff you find. But what happened was a big change. It's actually, to me, it was not a very big change, but it was for the mainstream profession, a big change, okay? And it's after the global financial crisis. A new literature emerged on what they called heterogeneous agents, new Keynesian models, or Hank models. Okay, the term is, you often see that sometimes if you want to Google or whatever. And Hank models allow for differences, for instance, in the level of income and wealth, let's say across different households, okay? So it's not a representative agent anymore, okay? You could differentiate them, which means now that each agent will have things that could differentiate them, the most important one being the different marginal propensities to consume, okay? Let's say if there's a change in monetary policy, okay, it's going to affect the wealth of individuals. So if you take that as the key element in affecting income distribution, in consumption, even more than income distribution, by the way, okay, then you could see how this could be recognized and therefore analyzed in some way. Okay, so for instance, you see that how changes in interest rates could affect lenders and borrowers differently. Okay, So you start seeing stuff like that, that these previous literature did not allow for. Totally, okay? So most of these models, however, when you actually look at them, and we discussed it in that paper in 2023, that chapter that I think I referred to in the reading list. And we discuss how there are problems with them, okay? In the sense that the outcomes that they generate from their analysis is ambiguous, and indeed is not easily tractable when you actually try to follow up on how these could impact different, the fact that there are differences if you have, these heterogeneous agents, is very difficult because it gets to be, remember, these are very mathematical models, and it gets very complicated mathematically when you allow for a lot of differences and you're trying to treat how interest rate effect impacts on all these different types of models, okay? So I'm just saying there are problems with it. And this is why, to make it easier, the ones that you would normally find are, they're more tractable, as I say, are the two-agent New Keynesian models, or the tank models, okay? And they were, basically, they developed into differentiating, for instance, types of households and regrouping them, okay? So you have, for instance, what they call liquidity-constrained households. I mean, it's a bizarre way to describe a very poor person. He's liquidity constrained, okay? So we have a liquidity constrained household, okay, that do not save, like at the bottom, remember, we have, they're all going into debt or whatever. And there are the liquidity constrained households that could have access to the financial markets and they could borrow and all. So you get all these different types as an example, okay? And they try to work out the consequence. Now, the effects of monetary policy on income distribution are more obvious, the way I look at it, if we actually just differentiate them by income groups, But they do that, like they even look at differences in inequality, okay? They look at inequality measures often, okay? So they do that. And maybe, I'm not sure of how you are familiar, but there are two ways of studying income distribution. And both are of interest, but some are not studied by the mainstream, okay? The one is the the size or personal distribution of income, okay? And by that, you see that often when they have these, like the Gini coefficient, the inequality indexes and so on. Those are studying the personal distribution of income. So when we divide it by, like we had quintiles or deciles and so on, that has to do with the division, which is of interest, okay? But it's a personal or size distribution of income. We call that in English, okay? And we must pit that against what is called the functional distribution of income. I don't like that term very well because it originates from the 19th century, okay, with the Ricardo and all that, who was interested in income distribution. But the idea that different social classes have different functions, okay? In a kind of neutral sense, but it's a functional distribution of income. And by that, we mean, of course, wages, profits, and interest, rents, and all that. They are class analysis of income. And in this case, heterodox economists, Marxist economists, post-Keynesian, and so on, institutional economists, most of them, they do class analysis. They studied income groups in terms of classes and how they interact. Not just you're high up, you're like whatever, Jeff Bezos there, whoever, Elon Musk up on the top of the income scale. And then you go down to the ones who are beggars in the street there, Washington, that on the bottom end of the income scale, okay? Now, so you could classify them, but they're all individuals still, okay? Just that some are rich and some are poor, okay? There's almost a bit of neutrality. It's not neutrality, always there is, they recognize the difference, but the vocabulary is still one of of individualism methodologically, okay, instead of class analysis. Okay? And instead, if you look at Keynes already in the tract on monetary reform, okay, he talked about class analysis and tried to analyze the dynamics of these class relations, how they are affected by central bank policy. Okay? Now, so if we, again, if we abstract like from the work of Keynes and post-Keynesian economists historically, one can trace back over a century. In fact, if you look here, it took the mainstream until the global financial crisis to recognize an aspect of income distribution, or what we call the income distribution channel of monetary policy. Okay? Because before the global financial crisis, they never talked about any of that. You will find, you probably will make $1 million if I were to bet, okay, that, you know, if you actually find something that they talked about like that. They didn't talk about it because for them, monetary policy is some neutral thing almost. Okay? And instead, we know that it is not. Now, this is, of course, often trapped in a kind of what I call bogus distinction between the short and the long run aspects here of, or effects of monetary policy, which post-Keynesians historically do not accept at all. Meaning that even within these groups now who talk about it, they will recognize that it could have an income distribution effect that is non-neutral in the short run. But like Karsten said, in the long run, there's no effect here because it's governed by other underlying market forces, whatever, you know. And so it cannot have that effect. Now, to understand why monetary policy is in its very essence an income policy, we call it, okay? What I will do is I will use as a simple framework the tract, the Keynes' tract model, let's call it, or definitions, basically. That's all they are, okay, as we'll see, of income groups and income flows, okay? Because we will be able to, I think, sort out the effects here, okay, and why it is an incomes policy, okay? And what do we mean by that, by the way? An incomes policy simply means that if there's a change that takes, if there's an act of policy on the part of the state, whether it could be on the fiscal side, it could be on the monetary side, or it could be simply controlling, like wage and price controls is a good example, okay? Where historically governments have introduced different forms of what are called incomes policies. So anything that impacts in some way through the policy decisions, the incomes of different groups, we'll call that an incomes policy. I mean, there's nothing spooky about that definition. That, you know, that's a simple issue. And what I have here, I divided income, YT, in my simple equation there. So which is prices times real output, Y, a little Y there, is equal to the wage bill, wages times labor hours, let's say, or labor employment, okay? Plus R, which is the rate, in this case, the rate of profit, okay, over capital, whatever that means. And we could get into this whole problem, but let's assume it's some value there, okay? And also, of course, interest. Now, I lagged at one period simply because it says interest on a debt that was incurred in the previous period that then comes up this period, okay? Just to kind of distinguish. Otherwise, you know, we could say it's in the same period, but then you got to worry about how it's going to be payment, you know, or literally at the end of the period, not at the beginning, and so on, okay? Just to avoid that, I just lagged it here. But the point being that we have these different values here. So if it's debt, when multiplied by the interest, the nominal interest on that debt, So think of it, there's so much debt out there. It could be mortgage, consumer debt, whatever. But think of it, they're all different. I mean, on the credit card debt is going to be a hell of a lot higher interest than what you'll pay, let's say, for mortgage. Okay. But let's think of it as a kind of average thing there, just for the sake of not differentiating all these different forms of debt. Okay. Just for the purpose of what it is, because otherwise we could never finish with this. Now, if we divide by y, and then we take the natural logarithm here of each of these, if you did a simple mathematical exercise here, okay, then you get that so think of it, the logarithm of the rentier share becomes rho. I have here, I'm using that symbol now, okay, which in a sense mirrors in reverse the dynamics of the logarithm of the share of labor, which is defined by the growth in wages, okay, relative to productivity growth, A. Okay, so if wages, if in this case, the real wage is growing more quickly than the productivity, then that means that the share of labor is going up. Okay, if the real wage is, so what I have here is the share of labor is simply the difference here. And you could see how they're related here. They just, as I said, they're just definitions. They're cataloging them right now, okay? But you could see the rho is the interest income growth or the rentier growth of income. Then the A minus W or whatever the Greek letter there, W is there, is the simply the we call the wage share in reverse because it's negative there, and profit share. Okay, they're all some, and they're growing at certain rates. And any policy measure now that attempts to control these money incomes, okay, must impact directly on these variables, these growth. Okay, historically, incomes policies. So any incomes policy must be impacting on either one or all even. It depends on which type of policy we're talking about. And incomes policies, historically. Now, we don't hear about it much today, but they were very, very fashionable, especially to control inflation in the 1950s and 60s and before monetarism. Okay. Remember when I told you, I said we had wage and price controls from 75 to 78, for instance, okay? Direct controls. I used to work for the railway unions as an economist, and I had to deal with the wage and price control stuff. So we could not negotiate more than the maximum allowable. So obviously it worked well for the employers in this case, for the railway companies, okay? But as in 1975, you know what I'm saying, okay? And so I'm just saying here that on incomes policies, these were things very, very common. In fact, as I said, they were usually restricted, but not totally. Like in our case, it was more than just wages, but often it was restricted to wage controls. Okay, because the idea was that if you control wages, then you could control prices because of the markups, or if they're constant. But in reality, they may not be constant, obviously. Okay, but it's true that if you control wages, it could impact on prices. Okay, now these incomes policies are of two types that you find in the literature. There's a top-down like policies where the nominal wage growth norm set for policy purposes by some government authority. Okay, so they decide on how much they should allow wage growth, either in direct control or through guidelines or guideposts, as they call them, as we'll see in a minute. And the second is the bottom-up type of incomes policies, or sometimes referred to as wage solidaristic incomes policies that we find especially historically in the Scandinavian countries. Okay? Often within the trade union organizations that were incorporated in controlling wages. Okay, but they were based on wage solidarity kind of policy. Okay, that, so you could say there are the right, which is the top down, or the more on the left, quasi left, because you can see there are problems with those too, the bottom up policy. Okay. Also, the more common top down type of policies have been voluntary norms for permissible wage growth. Historically, you find more of those than the direct compulsory ones. Okay? I'll mention some of them. All of you are too young, perhaps, to remember that because you weren't around. But if you go back to the 1960s and early 70s, you will have some of these top-down direct ones, and also some of the voluntary types. Okay. In fact, okay, for instance, during the time of Kennedy and Johnson in the United States administrations, they had introduced the wage, what they call the guideposts. Okay, meaning that they would announce that wages shouldn't grow more than, this guideline here, more than whatever, 5%, let's say. And they were expecting that this announcement, okay, would be followed by the employers more than the, let's say, the workers, because of course, the employers ultimately would have to agree to pay, let's say, the 5% increase. And if the government sides with them, saying, well, no, but Kennedy or whoever is telling us that, we shouldn't go over that because it would be bad for the US economy, blah, 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 okay, then they would have a harder time, even if it's a unionized sector, okay, to try to, if it's not unionized, it's much easier. You just, either that or bye-bye kind of thing. But if it is the unionized sector, would you strike against the guidepost, basically? Okay, it may not look as good. So there were these types, and there were different types. In the U.S., they had the guideposts. In Canada, we had the Prices and Incomes Commission that also announced these guidelines. Okay, in the late 1960s until the early 1970s, to control inflation, basically. In Britain, they had also the national incomes, and I can't remember the name of it, but between 1965 and 70, whatever, that were, again, guideposts or guidelines, norms that they established. Now you could say, well, that's fine. I mean, you could propose that, but in these cases, okay, in the case, this is the difference between the inflation targeting regimes. Now, if you look at using the central bank, okay, the monetary authorities, as you know, their simple rule is that they say, well, now we have a target of, let's say, 2%, as we see, for the inflation rate. It's a bit similar to the guideposts in a certain way, because they're announcing that we wish to achieve that, and that trade unions, where wage earners, should try to achieve a wage growth that is compatible with that to sustain price stability or whatever, slow growth inflation, okay? That is the same, but there's a huge, huge difference, okay? And the difference is that, well, there are a number of problems with it, okay? But one will, I'll say right away, all the incomes policies that I am familiar with, that I literally, as I said, I was dealing with as behind the union leader was negotiating, that I was behind in advising, okay, and doing this research. All of these cases, if you read the actual laws and what they enacted, all of them established it that would be income distributionally neutral with respect to wages and profit in particular. Not interested. They would never really talk about that much. Okay. Why? Because they would argue we are justifying, let's say, 5% or 2 or whatever, 3%, on the basis of having real wages being at least growing with productivity. So if you expected, let's say, long-term productivity growth in an economy to be 2% or 3%, whatever, okay? You wanted that real wages after inflation would have to grow commensurate with that productivity growth, okay? All of these policies, all of them, literally, and I've looked at them. As I said, one I lived with, literally, they had that justification. They were therefore concerned about income distribution and its neutrality in the policy to combat inflation. But take the example now of the inflation targeting. The inflation targeting, they announced 2%. We are committed to that, okay? And then they say, we expect the trade unions, whoever, the wage earners, to follow on that. Now, if you take it, if it's credible, as the central bank use as vocabulary, if it is credible, then the wages will also be negotiated along the lines of 2%. Now, what happens when you do that? Could anybody here tell me what would happen? Is there a bias in just looking at that? If wages, the money wages grow by 2% and prices go by 2%, what would happen to real wages? They're constant. But what about productivity? It's not constant. It's growing. No, productivity is rising over time. The long-term productivity is going up. But real wages are constant. So what happens to the share of labor? Collapses. And you know what? Ever since we've been doing inflation, not just inflation target, but combating inflation, even before the inflation target. If you look at real wages have been relatively constant, but obviously you see a bifurcation between real wage and productivity, which means that if you look at the share of labor, we're going to look at it in a minute, the actual share of labor in the economy, it collapsed. And especially, most importantly, during the IT periods, regimes. Okay? So you could see the bias. And why does it work? Because, and this is the other side of the coin, which is that every time they raise, let's say if you see the inflation rate goes up, and then they raise interest rates, then real interest rates will be maintained, okay? And also they say that if the wage earners in particular, if you see in the labor market that wages are growing too fast, they will use instead of the carrot, which is like the guidepost idea or just simply announcing the 2% rule, okay? It is with a stick, okay? Meaning that they will raise interest rates to slow down the economy, raise unemployment punitively in order to get wages to adapt to that norm. Okay? That's the nature of inflation targeting. It's an incomes policy to maintain wages, in a downward direction over time, so to speak, or real wages, constant, yeah. I mean, people are happy that they could get enough, to compensate for the inflation rate, but it's not enough to get their wage share constant. Instead, the original types of incomes policies were more concerned about that. They were all concerned about that. And you read any of that literature, you will see right away why that was such an important concern. Because otherwise, it cannot be justified on income distribution grounds. But in the case of inflation targeting, they talk about neutrality, but that's what I told the deputy governor, but it's not neutral. And in fact, it's terribly biased, okay? Against wage earners or even profit earners, but in favor of rentier, basically, because they're able to sustain over time that rentier income. Okay? And Therefore, although there are similarities in a sense, the way in which these more, they've been, by the way, inflation targeting has been relatively successful, but it was done on the backs of certain people, so to speak. Okay, and you could see this. There is a similarity. Okay, but the question is, of course, how is it biased when it comes to income distribution? And the question is, of course, that these voluntary guideposts, all of them, okay, if you were to think of what they were saying about the bias in implementing policies where real wages do not grow with productivity, okay, well, this is almost embedded in these inflation targeting regimes, okay, almost embedded. I mean, they could change the rules, but this, of course, is the way in which we we see monetary policy. Now, monetary policy regimes could, therefore conduct precisely this same form of incomes policy of the genealogical type there, of these guideposts. Okay, they're voluntary, but the difference is they're voluntary as long as you abide by it. If instead you do not abide by it, they will hit you over the head with it, okay, by raising interest rates. So it's, by definition, it's biased against labor, okay? And all these policies, as I said, had very important political consequences. I mean, because at the end, you're able to, the whole issue of fairness of monetary policy was something that would never be concerned, although in reality, in fact, the irony is not even like trade union. I mean, I've been involved for a long time and connected with some trade history. I used to teach at a trade union college for 18 years, okay? So I could tell you something about it, okay? I used to teach for a month and 2 months, actually, during the spring, summer, after I was teaching full-time at the university. So I could tell you a bit of what we did. But even the trade unions, when it came to the incomes policies of the old types, they fought them. They fought them. And you know why they fought them? Because, of course, it got into, they stick their nose into the collective bargaining. Because obviously, like the example I was giving about the railway unions, they capped the amount. So it couldn't be over, let's say, even though the inflation rate was, let's say, 1975 was 10% or something, okay? They capped it to 6%, the allowable, maximum allowable, okay? Plus with productivity, then it would have been 8% maximum if they expected inflation rate to be 6%. So they had these maximum allowable, which of course made it that the employer was happy, okay, because the inflation rate was generally, I mean, that they could raise ticket prices for, for freight or for passengers taking the railways, but they capped wages at a lower level, okay? So obviously trade union, and they could not, it was a law. It was not something you could fight, okay? The only thing you could negotiate is something lower than the maximum, which in a sense, who would want to do that, okay? And that's why they protested, they were against that, okay? But at least, and this is the irony, is that they were concerned about income distribution, where they allowed for productivity growth as well as an increase for workers. Instead, there was nothing, there's very little protesting, demonstrating, whatever, against the central bank that is seen above suspicion. It's seen neutral. And the trade unions even accept it politically, even though they're directly targeted, or indirectly targeted, because it's completely biased, that they cannot even get their productivity growth if they accept their wage growth to be equal to 2%, let's say, the target inflation, okay? the only good thing about it is they would be happy to say, well, at least we're getting the inflation rate. Yeah, by that. But you can see the problem of fairness there that is a concern. Now, this brings us to these different fair interest rate measures, okay? And which are basically different types of incomes policies that can be, in a sense, conducted by central banks. Okay? That brings us to what I would call the post-Keynesian perspective on this, and that you find already discussed in the tract a little bit, because he was concerned about in fact, in the tract, he used the Fisher equation as a way to measure the impact it would have on income distribution of rentiers. Okay, but there are different measures or indexes out there that have been used by heterodox economists and that have been established as rules for central bank policy, potential rules for central bank policy that would be different than these inflation targeting, very biased rules, okay, that are followed under the IT regimes. Okay. Now, one of these is the Pasinetti rule that I'll talk about, of incomes policy. Now, this economist, Luigi Pasinetti, wrote a book in 1981, a very important book. I know he gave it to me, his book, in 1981. I knew him very well. He died in 2023, in his 90s. But we had invited him to teach at the University of Ottawa for a semester. And his book had come out. And that's why I got interested in it, in this whole question. But years later, he gave me the book and signed it, and was happy to. But it's in that book, there's a chapter in that book, that discusses what becomes the Pasinetti rule, in a sense, or can lead to the Pasinetti rule. Okay? And Pasinetti posed what I would call a fundamental normative question of commutative justice. Almost if you know anything about Aristotle's theories of justice, okay, he had different theories of justice. And one of them was the commutative theory, or contractual justice, as it's sometimes also called. Okay? And pertaining in this case, however, to interest rate determination. And this was done by trying to conceptualize some form of interest rate rule that would preserve the value intertemporally of financial asset on the basis of what we could call, what Adam Smith would have called, the labor that it commands over time. It's not a labor theory value or anything of that to do. No, it's simply, he would argue, how can we justify, okay, on distributive or normative distributive grounds, okay, if you have savings, how could they be, what policy in place that would allow them in labor time, in labor unit terms, to remain constant over time? So if you've worked for your labor and saved something, okay, what would be the rate of interest that would justify over time that labor value in labor time? So it's a kind of strange way of framing this, okay? But it's a way of trying to do it through this, well, in a sense, would be in income distributionally neutral ground, as well, as we're going to see in a minute, okay? And there, however, although he posed that question that way, okay, in actual fact, and this is where I've been involved, okay, a lot of work there, trying to show that, in fact, there are actually two measures of what we call the Pasinetti index that allows you to be able to see that, to maintain that neutrality in labor time, okay? And there's, of course, but before I go through these two measures, I just want to backtrack a little bit on one thing here, which is that the way Keynes of the tract saw it in focusing on that Fisher real rate of interest way of looking at income distribution, okay? Which is also the way some post-Keynesian economists like John Smithen has framed a rule, okay? And which in his case is to set it at the zero real interest rate, okay? He thought that would be the way you should have as a norm for monetary policy, okay, for the overnight rate and all that, okay? Now, this should be contrasted with the way the Pasinetti rule was first framed, okay? Which is more akin to the way these incomes policies were being pursued in the early post-war era, where they tied the real rate of interest to productivity growth, to be equal to a long-term productivity growth. And that's what we first started proposing as a way to have a distribution neutral, incomes distribution neutrality vis-a-vis rentier and non-rentier income in the economy. And I'm just going to show you something here. I mean, it's no use just talking about the theory. That sounds a little bit exotic, okay? But I'm going to show it to you in terms of some data that I had there for a paper I did there years ago. This is the evolution of the Fisher long-term rates of interest, okay, for, you know, a whole bunch of countries there, okay? And what is obvious, and I could see why John Smithen was very good, because he wrote a book called The Revenge of the Rentiers, if some of you may have been familiar with it, because he argued that the period of the 1970s, okay, was a period where there was almost a kind of euthanasia of the rentier for most countries, meaning that real interest rates were very negative, as you could see there, because interest rates didn't change, didn't go up as the inflation shock there, you know, the oil prices and all that appeared. So as you can see now, not all the countries, but most of them, okay, they all slowed down, but some really deep, depending on which countries here. I'm not going to try to decipher them for you, but you could see the pattern here, okay? And you could see also what happened when monetarism came in initially, and then on with inflation targeting, okay? Where you could see that this is where you get the revenge of the rentiers period. And until when? Until the financial crisis, okay? But it's still, you know, and went down here, depending on the countries, okay? So it's very interesting here to see. Now, this is using the Fisher equation, simply, measuring the inflation, let's say, nominal interest rates minus inflation, okay? As a kind of index of the income distribution effect between rentier and non-rentier income. But then we're going to look at what I call the traditional Pasinetti index, and then the other one, which is the labor command measure there that we were talking about. They had less data because, you know, as I said, with labor command, you have to get data for all these countries for wage growth and all that, as we'll see in a minute. But start with the traditional Pasinetti index. What is it exactly? And how it is close to the way they used to do incomes policies before monetarism and inflation targeting came in, okay, in controlling inflation. The way we formulated in a number of papers in the 1980s that I was involved in writing, the way Mark and I in particular did it was using this measure here, which is simply the difference between the real, well, long-term, meaning these, because you could use different, it could be the overnight rate, you could use different ones. But if it's pertaining to rentiers, it should be people who hold bonds and securities, for a long time usually, okay? And they just live on that rentier income, okay? And so we use that, but it doesn't matter, they're all the same. They move in tandem. Short-term and long-term, they fluctuate less in the long term, but they all move in the same direction. So it doesn't really matter in the sense which one you use. But we did that, and it's the difference between what, just like we did for the income flow, is the difference between wage growth and productivity growth, okay? That stabilizes the share of labor. This one was the difference between real interest rates and productivity growth that we argued would stabilize rentier or non-rentier income. Now, where they would be neutral would be the straight line here at zero, where the gap. So you could see there was a kind of euthanasia here. There was a slaughter of the rentiers in the 1970s. They were squeezed. But then you got the revenge year, okay? They all got big increasing shares, okay, using the Pasinetti measures, okay? And then you can see COVID, it kind of collapsed initially only, because since 2022, it's been the opposite again. Yeah, I only had until 2020, so I'm sorry that, I don't have the data for later here. But for all these countries, we see the way in which inflation policies, what we call inflation first policy over everything else, is in fact rentier first, as we argue, okay, in a very clear way just by looking at that, okay? And this is the labor command version of the Pasinetti index, okay? And the labor command version is simply the real interest rates minus real wage growth, okay? And you can see it's the same phenomenon, but there are less countries because we can get some of them for the wage data, okay? But it's similar, okay? So they all have, what you see here is the same pattern, no matter what you look at here, whether it's the Fisher equation, which is, or whether it's the traditional Pasinetti index, or whether it is the, what do you call it here, the labor command, Smithian labor command measure, all of these tend to give you, okay, the same effects here in terms of the evolution of rentier vis-a-vis non-rentier income in society. And actually, I have it here for until 2021. I contrasted both the Pasinetti, the two Pasinetti index. You can see they're very similar. They're not identical. And the difference is simply because, if you, the traditional one, which is the difference between real interest rates and productivity growth, it would be fine in a world where real wages, okay, where the wage share in particular is not fluctuating much and it's not falling. Instead, as you can see, the labor command measure, usually it's a bit higher, because in reality, what also was going on was that the share between labor and profits and all that, the wage share, was also declining throughout that period, okay, or most of that period. And most dramatically during the IT regimes of the 1990s onwards. But you could see, even with that difference, nonetheless, both of them show a similar pattern in all cases. Now, look at it in terms of the wage share, okay? And you could see here, the same thing. In the 1970s, the wage share is sort of, depending on the country, some of them started lower than others. You have different regimes in different countries, And also because in some countries, if you have, for instance, the agricultural sector where you have, let's say, independent producers, they are not, they're not included in the wage part. So if you take Mexico and Canada, for instance, you won't have, the levels are going to be starting at a different one. So if you have a bigger agricultural sector than, let's say, a more industrialized country, you're going to see that, the difference. So in a sense, it doesn't matter where, it's not the scale here. It's which way it's going. And what we see is all of them, they're going down, okay? But more importantly, when did they mostly go down? If you take just Canada here, which if I could find it here. Yeah, Canada is this one here, okay? Well, you could see here it's going down and, no, is that what the one? No, Canada is the red here. The heck is it? Oh, it's here, excuse me. So it was not going down initially, then it started to go down. But the biggest drop is between 1991, ironically, and the financial crisis. And I have some other graphs where it shows more dramatically that it's a bit more confusing because there are too many of them now in there. But I just want to show that this is a pattern. There's not specific only to one country. This is the case for most of them. Some more dramatic than others. But all of them show the same phenomena here, that the wage share is falling most of the time. And it happens mostly after they start instituting what we call here inflation first monetary policy. Okay? Now, what can be inferred here, of course, is that the wage share declined almost universally, okay? Especially during these IT periods, regimes. And until they started becoming flexible in IT, inflation targeting, flexible inflation targeting, where, as we saw there, they kept interest rates low, real interest rates low, okay? Which of course meant that they're going to start squeezing the rentiers. But if not, it's the other way around. They're squeezing mostly wages, not even profit. Because during that whole period after the financial crisis, it's interesting, markups on the profit side were actually rising somewhat, okay? And so clearly, okay, you have these huge rentier gains and all that happening during that era of anti-inflation policies, where the sole commitment here, the sole objective, mandate was to fight inflation. And of course, this brings us to a question that I wrote with that former student there we had from UNAM that we did for INET. And it's the question of, is inflation first really rentiers first, okay? Now, everyone, I think by now, since we already gone through it a bit, is familiar with the Taylor rule, okay? As compared to the Yellen rule and all that, okay? But what it says simply is that if you take this Taylor rule equation again, as soon as there's a gap, a positive gap between these, whether it be the output gap or the inflation gap, they should be raising the real interest rate, okay? So if you take the equation, I just rewrote it here, this one here. It says that real interest rate, okay, is equal to rho, which is the natural rate, and also alpha, the inflation gap, 0.5, let's say, the usual weights, and also the output gap. But if there's no inflation gap and there's no output gap, okay, then the real interest rate should be equal to rho, okay? But if there is a gap, then they should raise the real interest rate, right? So if it's above 2%, let's say the gap between inflation now and the inflation target, they should be raising interest rates. And the real interest rate, not just the nominal interest rate, the real interest rate, as we could see from that. And that should be contrasted now, I will argue, with another rule that I am familiar with. It's an older rule, but it was never really a rule because there was no central bank that literally adopted. They tried in Sweden in the 1930s, but they never actually did, to my understanding. Okay, and it's what I'll call the Wicksell rule, following this famous economist of the late 19th or early 20th century, which I'll contrast with the Taylor rule. It's almost the same, but there's a big difference here in terms of the importance of it. The Wicksell rule took the nominal interest rate, okay, and then you could put in all the Taylor other, on the other side of the equation that fits in the Taylor rule. The only difference, so you still have all the other components, but it's a nominal interest rate rule, not a real interest rate rule. He didn't think he could, for him, it was not. So he argued basically, if the inflation rate goes up relative to zero or whatever the target is, they should start raising nominal interest rates, the central bank. Which in reality, this is what they actually do, but you could figure out what it is in real interest rate terms, of course, because given the inflation. But he never was concerned about that. He just felt that this is the way central banks should be following the rules. Now, if we ignore the output gap, why? Well, because he assumed full employment. He wasn't concerned about that. Okay? He was not concerned about that. So actually, I don't know why. I think I have y. I didn't put, this is q. Again, I made a mistake here. Y is equal to y star. Okay, I'm sorry. So in his case, the Wicksell rule is much simpler. Okay? It simply says that I is some plus constant, something, there's a plus whatever is the inflation change. Why? Because we're at full employment, so the other component is out, the output gap, or a potential output all the time. And two, that his target was zero. Okay? It wasn't 2% in those days. When he just simply argued that, if inflation is going up, we should stabilize it back to zero. Okay? Therefore, it means that. Now, the properties of this reaction function are of some interest here. Okay? Because if you look at it, it resembles almost a hybrid, what I call Fisher equation. Okay? That is to say that whenever inflation goes up, okay, nominal interest rates should go up. Let's say, now the question, do they go up proportionally or not? But if they go up proportionally, that means that the real interest rate will be constant, okay, over time. It will be a constant. And that's the case depending on whether alpha, the coefficient of adjustment to the inflation rate, is either equal to 1 or less or greater than 1. Okay? Now, the reason why I did this complication here is because we wanted to pit what the Wickelsian view of it, which is what inspired Taylor, relative, or Taylor, Woodford, all these people who defend this approach, which is the original one, relative to what they propose, which they say was inspired by them. But in actual fact, we're going to see how biased it is. Okay? And unlike the Fisherian kind of explanation here, if you get a stable C, real rate, okay, it is not because of the result of any market forces, that give you a rho value at the end, like in the Taylor equation, but simply because it's the result of the policy that he suggested. You don't have to follow that policy, but if you do, you're going to keep the real interest rates constant, okay? And because it's the result of the outcome of this policy decision, okay? Now, so in reality, if you were to kind of apply that to the way these central banks were behaving now, and you think of the VIXEL rule, what it would have been as a kind of way of comparison, okay, then you could look at the value of alpha prime there, that coefficient of response, right, to inflation, if it was unity or if it was greater or less than 1. And obviously, VIXEL himself, he talks about that, by the way, in his book that was originally published in Swedish in 1898. Okay? VIXEL felt that because of what I call the sluggishness in the behavior of the monetary authorities, okay, in adjusting the money rate to the inflation rate, meaning that they're always trying to catch up. They realize too late almost that inflation has gone up because there's a lag in recognition. Okay, you need a statistical agency that didn't have in 1898 to begin with. Okay, but more importantly is that the decision lag also. Okay, that normally alpha would be less than 1, which would mean that real interest rates would actually fall initially when they see inflation going up. So their response, think of it again, they have a mandate of trying to keep inflation at 0. But then the question is, how do they do it? And the way they do it is by adjusting the nominal rate each time, like the overnight rate or whatever it's called here in Mexico. But in this case, would it be proportional or not? Okay. So he believed that it wouldn't be proportional. It would be it would be less than 1, the actual value. So the values of alpha prime being, let's say, greater or less than unity would simply indicate what I say are either an overzealous central bank that would just act very quickly, or a less committed central bank in combating inflation that would respond more slowly to that change in the inflation. Now, it is important to notice, however, that the natural rate, the natural rate variable does not appear anywhere in the reaction function there. Okay, it's very important because, as I said, there's a mini industry in central bank research that tried to estimate it over the last decade. They've been trying to estimate what's the natural rate or the neutral rate. But he said, he assumed that the natural rate was something we could never observe. We could only observe it by seeing its outcome in terms of price changes. So if inflation is going up, okay, that means that the money rate of interest is too low because the natural rate must be much higher. And conversely, but the natural rate is not observable. So we only know it implicitly by the consequence out there, which is a bizarre thing. It sounds almost religious, the way I see it. There's something out there, and it tends to then lead to that. Now, in 1898, he argued clearly that it could only know it from logical inference. Okay. Now, I tried to show here. So if you look at the continuous line, it's what that natural rate is supposedly unobservable would be doing here in a sense. So let's assume it's going up and down, okay, as I showed. This is the continuous line. What happens to the real interest rates now? Well, If alpha is less than 1, which is the partial adjustment one, that means the real interest rates now would fall as the natural rate is going up. And inflation is rising with it. And it would lead to a fall in this real interest rate. If instead it's full adjustment, it would be constant. The real interest rate would be a pure constant. If it is over proportional, meaning that they're so acting on it, well, it would lead to, as you could see, a rising interest, real interest rates as well, that would go in tandem with the natural rate, supposed natural rate. Now, why is this of importance here? Because if you look at the Wicksell rule, which tells you, he thought actually would be the real interest rates would be falling, because it's sluggish reaction, it's not quick reaction by these central banks. It would be partial adjustment. Well, if you look at the way the Taylor rule is framed, now I don't have too much time to discuss this. Obviously, I only got a minute left probably, okay? And if you look at this, the Taylor rule, what does it say? Let's abstract for a minute the output gap issue and just focus on when if the inflation is higher than the target. What should they be doing? They should be raising the real interest rate. Raise it. For Wicksell, he thought that they would not rise, it would fall because they would not adjust quickly enough. So we have here what is called the overzealous form or the overcompensation form on real interest rate. So it's not neutral. If the neutral one, if we could call it that, would have been where it's constant, real interest rates. But what we get from the Taylor rule is that it should be the overzealous one. And we looked at data on that. We did a bunch of regressions, pooled the ordinary least squares, instrumental variable regressions for a whole bunch of countries, for 9 of them, okay, for these periods, to see how these central banks would behave. And guess what was the outcome? It was the Taylor rule one, which is the overcompensation each time for rentiers form, okay? And obviously, this is where you get into the problem. Now, what should they do? I'll leave. Maybe I'll leave for tomorrow. I'll just say a few words about that. It's all about the actual rules themselves that have been proposed, okay? Because there are a whole bunch of rules, okay? So you could see here that the Taylor rule is a very biased rule, okay? Very biased. And there are different rules, like the Pazinetti one, but we're going to look at these. Well, I'll do it if it's. There's the Kansas City rule. There's the Pazinetti rule, the Smithson rule. They're all different, a little bit different. They're all similar, okay? But all of them try to address exactly this problem of the neutrality of the monetary policy, okay? And we'll all I have to say here is that the mainstream rule, that is the one that exists, is by its very nature biased. Not only is it biased against labor share, as we saw, but also it is biased in favor of the overzealous compensation effect of the higher inflation. So if you adopt if you actually seriously adopt the Taylor rule, okay, then it would lead to basically it's a kind of support for rentier income, basically, okay, for those who do not earn their living, but just have it coming from the possession of that value, financial capital assets. And The way in which the non-mainstream has posed the question has been to essentially reduce, try to eliminate that effect by proposing these neutral types of policies. But they're not all the same, okay, with regards to rentier income. Okay, I'll stop there, and but as I say, I'll say a few words maybe tomorrow about the last thing, because I might take too much time now. Okay. Okay. Well. Okay.